Thank you very much for your feedback that you couldn't hear us. I'm so sorry for that. So welcome back in 2020. That's what we wanted to mention here. Welcome back to 2020. We are glad to have you, and we hope that money is also one of your New Year resolutions. And this webinar, we will run you through the important asset classes, as well as deep dive on ETF and funds, and why we would recommend you to get started with investing with one of these solutions. We have, over the next few slides, a few key asset classes that we will cover. You can see them on the slides and go into details for each of them. You just wanted to say before also why we don't cover Bitcoin and all the trendy
derivatives and other fancy stuff. We don't, and we do that very consciously because in our mind that's something for much more sophisticated investors, and we want to build also in our webinars, bit by bit. So we'll leave that for later. We'll cover them at some stage, but that's not how we're going to start 2020 at least.
Good. So let's dive into probably the key asset classes you all know. It's cash. Cash is a very important asset class to hold because it helps you to go through the short-term investments or to make sure you are able to pay your daily expenses. It's something you should have on the side for the short-term investments that you plan. So we would say up to 3 years. It's important to have enough in case you plan, for example, to buy a new car, or also for school fees of your child, or for special sport equipment. Of course, with today's time, with cash, you don't really have a huge return. Currently on the bank accounts, you get 0 interest rate, so you actually don't really get something for it. So that's why also for a long-term investment, we will strongly suggest you to keep other investment opportunities in mind, like ETFs or stocks. But yes, hold enough cash also to make sure you have enough on the side for unforeseen occasions, for example.
Yeah.
Fixed income and fixed income security and bonds. Many of you will know them as treasury bonds, investing in companies or states. These have a image of being very safe investment opportunities. However, at the moment, with the very, very low interest rates, they are not very much recommended because you also don't get a high return, and sometimes it can even be a minus return, so a negative investment
Yeah, I
rate.
think with several government bonds, for example, these days, you get negative yields. Yes, it's very safe, but at the end of the day, you lose money. So to really get a return in bonds, you either need to go into very, very long-term bonds, so beyond 10 years very often, or you need to get into very risky bonds. So companies that are financially rather weak have to pay higher interest rates. That is a judgment call, whether you get compensated sufficiently for that risk. We feel it's something to stay away from for the time being.
Yeah. Real estate or owning a property, I think that's a very attractive asset for many of you, especially if you, of course, want to buy real estate for your own. It's, I think, over the last few years, one of the best performing asset classes.
Yeah, by far.
By far. Here, very important is the location. So if you really invest in a property, and of course you need a certain minimum investment and cash that you can give in order to get mortgage fees and stuff. But it is important to really consider a good location to have it safe for a long-term investment.
Yeah, I mean that's that's clearly the key. And if you wanted to invest more in a more diversified fashion, or also don't have the money, or can't get a big enough mortgage to afford your own home, there are vehicles how you can do that. They're called REITs, real estate investment trusts, and they give you access to the real estate market as a whole. So you could have benefited, in particular over the last 10 years of rising prices in the real estate market. There's probably a bit more to go, although prices are, as you probably know already, very, very high. Returns tend to be low in this asset class. So it's maybe also not on the top of our list.
Commodities, maybe currently in the news is the gold price, which has been rising over the last few weeks due to the iron crisis. And this is especially the commodities. It's a special phenomenon that gold usually rises if there is a crisis somewhere.
Yeah.
This is just what we see at the moment. However, we would still recommend you, if you're not a professional investor, to maybe use gold as a jewelry rather than an investment, because it's very difficult to really find the right point to get in and then the right point to get out. There is no interest rate to it. It's really just what you can earn by buying and selling at the right time.
Buying low, selling high. Also, I think commodities is a very, very wide field. I mean, most of you know gold, there's and also silver. There is industrially used materials like copper and other things. There is agricultural products, wheat, for example, or pork bellies, and all those things. It's a very, very diversified field. It's a lot less liquid, a lot less transparent than some of the other asset classes. So certainly something that you might not want to take for your first few steps in investing. Certainly an interesting area, but we would much rather have a look at
equities and shares.
Surprise, surprise. Well, what is equity, or what are shares actually?
It's an investment that you take to have a part of a company. So if you hold equities or shares, you're a shareholder of a company, and with that you have direct impact into the business of a company, because you're a shareholder. So you have a certain right to also attend meetings, and then of course impact the business as much as it is possible. Of course, as a small investor of it, you have less impact, but you will have the benefit is you get dividends. So this is one, and it's a long-term investment, because we suggest to hold it over 5 to 10 years, and also different researchers prove that if you invest 8 years plus, that usually you always have a positive return on it. It's a bit more risky, but there are various different ways to make sure you have it diversified, and with a diversified portfolio, you can then make sure to have a stable growth on your profile.
The important part about shares is they tend to have two sources of return. One is, as you already mentioned, dividends. Most companies do pay dividends, some more than others. So typically you get an ongoing income from that investment, and also you get hopefully an increase in share price. Now, if you do that, as Desiree said, with a long investment horizon, the chances are, and at least history has shown that consistently over decades and longer, you tend to have reasonably good returns, somewhere around the 6 to 8%, sometimes a bit less, sometimes a bit more. Now, the question is which ones to take, and that's where our recommendation is go for something that is diversified. You don't know, very few people, actually nobody knows, whether Apple will outperform Microsoft next year, or whether you would be better off buying Coca-Cola or Novartis or P&G or somebody else. So holding a diversified portfolio of stocks is certainly key from a risk management perspective, and over the medium and long term will remunerate you with reasonable returns. Now, the question is, how does someone that, and most of us will be in that boat, have only a few hundred or a few thousand pounds or Swiss francs or euros to invest? How do you get or put together a diversified portfolio?
And there is exactly what we mentioned in the beginning, the opportunity to invest in a fund or in an ETF. But just before we jump to that one, we wanted to show you quickly an overview of the different asset classes of stocks, bonds, and cash on that slide that shows you very nicely over the last few years how they exactly perform in certain stages. And maybe, Michael, you want to just quickly give a deep dive on what we can see here. So that kind of like rounds up the asset classes we just were talking about, and then we would like to run you into the ETF and funds and explain in more detail how they function and how they work.
Sure. I mean, what you see here in different colors are the main asset classes. The green one that comes out on top at the very end is the FTSE All Share Total Return Index, so a proxy for a diversified equity investment. What you can also see though, and you see that in these red circled areas, it can also significantly underperform the other asset classes. So shares are risky, investments in equity are risky, even though they are diversified. So that is why the combination of having a long time horizon when you go into equities and the diversified approach is the one that over the medium and long term typically wins. Also in relation to other asset classes, as you can see here over this 20-year horizon, where shares came out on top. They are sometimes above the other asset classes, sometimes below, but in the long run, they outperformed all the other players in the game. One word on diversification, that can happen across different dimensions. It can go across industries, so you could diversify a portfolio, for example, in technology. You could put in some banks or some other financial service providers. You could buy some for some pharmaceutical stocks. What you should always consider is diversifying across countries. Most of us have what's called a home bias. We like to buy not just things, but also investments and stocks that are from our home country. That is, from a diversification perspective, not the best thing to do. Because you will lose out on the potential and typically higher growth of companies outside of Europe, for example. So geographic diversification is an important element. And I would suggest we go on and have a look at two instruments that can achieve that reasonably easily and also reasonably efficiently. They are funds and what you might have heard already, ETFs, or exchange traded funds. They share a number of similarities, but also important differences. But staying at the important point is, or important points, are the followings. Both of them have a multitude of investors, often thousands and more investors. So they have a big pool of money available to them to invest. And they invest in accordance with an investment policy that you can read and have available to yourself before you invest. Now, many of the ETFs, at least, are what's called passively managed, or they don't have a management team that actively goes out and picks one stock over the other. But what they do is they replicate a broad market index. For example, the FTSE 100 or the S&P 500 or the MSCI World, which are very broad equity indices. And what they do is they replicate these indices. So you as an investor can participate in the 500 stocks, for example, that make up the S&P 500 or the 100 largest UK companies that make up the FTSE 100. And you can do that with as little as 10, 50, 100 pounds, which you would not be able to do. You would not be able to buy all the 100 companies in the FTSE 100 with, call it 100 quid. It's just literally impossible. So here is one of the big advantages of these two instruments. They allow you to, with relatively small amounts of money, get a very diversified exposure. And you get an exposure to a broad market where stock picking, i.e. what some managers feel they can do, foreseeing the future that is, doesn't really play a role. In summary, because we are a little tight on time now also, what are the key benefits of, in particular, ETFs now as opposed to funds? ETFs as funds offer diversification. We'll see a bit later, they can also have a certain theme, which might gel very well with you as a particular investor. They're very cost efficient. They tend to be a fraction of the costs of a typical fund. You're talking 2 to 3% for funds versus 10, 20 or 30 basis points for a typical ETF. They allow you, as we mentioned, to put small amounts of money to work. In particular, ETFs are extremely liquid. You could buy an ETF in the morning and sell it in the afternoon if you felt you had made a good return. So they're quite flexible. And importantly also, most of us are not experts in investing, so we don't have the time to monitor markets. We don't have the time to look at individual possible investments. It's very, very time saving.
I'm personally a big fan of ETFs because all my investments are done with ETFs. I have what we just covered before, different themes that you can focus on. So maybe many of you ask now or have a personal preference and they say, I would love to invest with a certain preference, with a certain personal bias to something, because in a positive way. So in a social purpose, which is at the moment a big trend, for example. So here are definitely enough opportunities to choose indexes that look at a very specific theme. And here is just a high level of theme examples that we put together. Let's start with the social ETF examples. So there is, for example, a social index, which holds then companies in that index that have a specific social purpose, or you can have the gender diversity focus. So if you want to invest in companies that put gender diversity as one of the preferences and their preferred goal as a company, in the sense of having paternity leave, in the sense of pushing women to management positions, there are companies in there which really hold that as their core values. And that's a good point to then maybe also invest in companies you believe are following the right values and values that align with your own values. Global impact or clean energy are a few other ideas as well, and trending here quite a lot. On the market side, you can of course also invest in certain industries. So there is, for example, technology indexes, and there are country-specific indexes if you prefer that, but we just heard about the home bias. But for example, if you believe the emerging market is coming over the next few years and growing up, so you could specifically invest in emerging markets companies, or market indexes like NASDAQ, SMI, or of course top 500 S&P companies as well. So I think that's a good start to think about. So if you really want to go and start investing, this is a good point to start. Think about maybe what's important to you. Maybe you have a passion, or you have a certain market you would like to prefer, or a certain industry. Think about this, and then maybe have a browse in the web. What indexes are there? What ETFs exist? ETF is actually very simple to invest. You can go to any bank, so almost all banks offer this, or you can also easily do it with online tools, e-trades, or online advisors, so robo-advisors out there. So the ETFs are quite broadly available. This is a good start to have it, or just contact and call up your advisor if you have one in a bank, and ask him for certain suggestions or ideas about ETFs you could potentially invest and that match your values.
And you will be in good company, because the ETF market since the early 90s has grown exponentially, and the largest ETF funds out there have in excess of 100 billion of assets under management. So you'll be in good company. There's good reasons why that growth has appeared for the key benefits that we mentioned earlier. And if you feel this is exciting but you haven't heard enough, which hopefully is the case, then there's one or two things we have that could help you.
So for those who are maybe based in Switzerland, we will have next week a deep dive session here in Zurich at the WeSpace location, where we cover the financial product theme, plus in a deep dive also the ETF topic. We will look through real cases, fact sheets, see how you can invest, how they perform, how indexes work exactly.
What it all means.
So feel free to register. You can find everything on our website, smartpurse.me. You can sign up there and register through an Eventbrite link. The next webinar is planned in a month's time, which will be all about life stages and how they impact your finances. So we hope to see you there again. That will take place most likely out of UK next time.
Yeah.
So
our colleagues will be their turn.
Exactly. So we are looking very much into having you back next month, or for those in Switzerland, to have you at our event on the 22nd of January. And we hope you liked our webinar and it was insightful for you to kind of like kickstart it into your money plans for 2020. And if you have any questions, also feel free to just email us at info@smartpurse.me. Anytime we are available for you and help you wherever we can.
Hope to see you soon. And if you have a little bit more patience, we'll for sure do another webinar also on ETFs, where we do a bit more on it, more than a deep dive than we managed to do today. But it's a broad and very interesting topic, so we also happily revisit it. All the best. Have a great week. See you soon.
Thank you, everyone.